Let's dive right into this explainer and demystify the absolute chaos of intraday charts. Seriously, if you've ever stared at a 5-minute chart and felt like it's just pure noise and random spikes, you are definitely not alone. Today, we're unpacking a fantastic 10-minute source video that breaks down Al Brooks' legendary bar-by-bar price action methodology. Brooks, who actually went from being an eye surgeon to a professional trader, spent decades studying these raw charts, and he realized something huge. The market isn't random noise. It's actually a highly structured, continuous conversation between buyers and sellers.
Here's our agenda for today. We're going to cover spotting institutional footprints, decoding individual price bars, market states and inertia, breakouts and trend reversals, the math of trading, and lastly, professional trader psychology.
Section 1. Spotting institutional footprints, reading the water. Okay, to really understand raw charts, we have to swallow a pretty hard truth right off the bat. Financial markets are completely dominated by the massive orders of institutions, not us. We're talking hedge funds, big investment banks, and those high-frequency algorithms. Individual retail traders like us, we're basically tiny pilot fish, and the institutions are giant blue whales. Think about it. If a pilot fish tries to swim against a whale, it's game over. It gets devoured instantly. So to survive and actually prosper out there, we have to learn to read the water pressure and swim in the exact same direction as those whales. We aren't trying to move the market, we just want a free ride on their massive waves. Now, when you strip away all those lagging, overly complex indicators, your MACDs, your RSIs, you start to see the real picture. You can actually see the undeniable footprints of institutional money flowing right there in the raw price bars in real time. Because their orders are just so massive, they literally cannot hide them. They have to leave tracks. And you'll see those tracks show up as strong trend bars, persistent gaps, and really tight channels. Basically, everything you need to know about supply and demand is right there in the raw price bar. Moving on to Section 2, Decoding Individual Price Bars, the micro level.
So we really need to get a grip on the micro level before we can even think about the macro picture. And the absolute foundational building block here is the trend bar. A trend bar basically screams institutional urgency. It's telling you loud and clear that either the buyers or the sellers were aggressively in control from the second that bar opened until it closed. Take a strong bullish trend bar, for example. It's going to have a large body, it closes right near its extreme high, and it has almost no wicks on top or bottom. When you see that, you know buyers absolutely dominated that entire time frame. No hesitation.
On the flip side, we have the trading range bar. You might know it as a doji or a spinning top. This bar is all about indecision. It shows that both sides were fighting hard for control, but neither had the juice to actually win. The result? A state of neutral balance. You'll see the open and close clustered super tight together in a small body, surrounded by long wicks on the top and bottom. It's literally a visual representation of a stalemate. And honestly, this is where retail traders who try to guess the breakout just get chopped up and completely frustrated. All right, Section 3, Market States and Inertia, the meso level. Let's zoom out just a bit and see how these individual bars actually cluster together. Because at any given moment, the market is really only doing one of two things. It's either in a trend with extreme urgency, making higher highs or lower lows, or it's trapped in a trading range, just bouncing horizontally between a floor of support and a ceiling of resistance. Knowing exactly which state you're in is absolutely crucial. Why? Because if you try to use a trending strategy inside a choppy sideways range, well, you are going to absolutely wreck your account. And that brings us to the very powerful rule of market inertia. This whole concept revolves around one very specific, very important number, 80%. The rule of inertia basically dictates that the market strongly prefers to just keep doing whatever it's already doing. To put that 80% into perspective, 80% of all reversal attempts in a strong trend, they're going to fail, turning into nothing but a brief pullback. And at the exact same time, 80% of all breakouts from a trading range will also fail, snapping the price right back into the center of the range. This is where amateur traders lose their shirts. They constantly fight inertia. They try to short the top of a roaring bull trend, or they buy the top of a trading range breakout just out of pure FOMO, fear of missing out, and boom, they get trapped instantly. Let's get into Section 4, Breakouts and Trend Reversals, the macro level. Okay, zooming out to the macro level, let's look at how this builds into actionable setups. It all starts with a spark of every new trend, the breakout. But how do we tell a real breakout from a fake out? Well, to avoid getting faked out, you definitely need to see a strong breakout bar punching through a boundary. But honestly, the follow-through bar is even more critical. If you get a massive green breakout bar, the very next bar absolutely has to be green and close higher to prove that the big players are actually willing to keep buying it at those higher prices. Add in a breakout gap where the low of the new bar stays entirely above the high of the previous bars, and you've got undeniable proof of intense institutional urgency.
But what about when a trend actually dies? You have to remember, turning a massive market trend is like trying to turn a fully loaded cargo ship going at top speed. It just doesn't happen on a dime. It requires a really strict 4-step major trend reversal sequence. First, you need that clear, sustained trend. Second, a strong counter-trend breakout that literally breaks the major trend line. Third, you want to see a weak retest of the old highs. And finally, the 4th step, reversal confirmation. Waiting for this exact sequence is what stops you from trying to pick early tops and getting completely wiped out.
Which brings us to Section 5, the math of trading, the trader equation.
Here's the thing, you can be a flawless chart reader, but if you ignore the cold, hard reality of mathematical risk management, you will still fail. It's that simple. Every single trade you take is governed by what's called the trader equation. This calculates the expected value of your trade by balancing 3 things: your winning probability, your potential reward, and your potential risk. Every single trade must have a positive expected value, period. That means placing a logical protective stop loss the exact second you enter the trade and dynamically sizing your position so you're never risking more than 1 to 2% of your total capital.
When you look at this table, it beautifully maps out how you have to adjust your targets based on probability. In a high probability environment, like a really strong trend or a tight channel, your win rate might be up around 60 to 70%. In that case, you can get away with a 1-to-1 risk ratio where your reward equals your risk. But if you're in a choppy trading range or looking at an early reversal, your win rate drops to maybe 40 or 50%. Mathematically, for you to survive over the long haul in that environment, your winning trades have to be 2 to 3 times larger than your losing trades.
Almost at the finish line here. Section 6, Professional Trader Psychology, the meta level.
Let's talk about the brutal psychological crucible of price action trading. Because let's face it, the market is practically engineered to exploit our desperate human need for certainty. Your biggest psychological hurdle is just accepting reality. And that reality is that 90% of the time, the intraday market is stuck in a state of 50-50 uncertainty and neutral balance. Absolute certainty, it's a complete illusion. It's only about 10% of the time, during those strong spikes and powerful breakouts, that the probability actually surges in one clear direction.
So why do amateurs always seem to lose money here? Well, it's because they demand that absolute certainty. They sit there watching a trend go higher and higher, way too scared to enter. And then, right when they finally feel certain enough to buy into that massive parabolic wall of green bars, the trend exhausts into a buying climax. Right at that exact moment, the smart money, the professionals who operate strictly on probabilities, they're using that rush of retail liquidity to sell and lock in their profits. Pros just execute mechanically, and they view their inevitable losses as nothing more than a routine business cost, kind of like paying rent. As this quote beautifully highlights, becoming fluent in the language of price action isn't an overnight thing. It takes immense patience and literally thousands of hours of screen time. But the ultimate payoff? It's incredible. Once you become fluent, you don't need magic indicators or some secret algorithm. You can just open a clean, raw chart and instantly read the true story of where the money is flowing. The market is always going to be an uncertain place, but with this framework, it absolutely doesn't have to be a confusing one. So here is my final question to you. Are you ready to abandon the comfort of absolute certainty and finally start trading the reality of probabilities? It's a complete game changer once you do. Keep studying those bars, always respect your risk, and I will catch you in the next explainer.